Welcome to Have You Read It, the channel where we bring books to life, one summary at a time. Today we're exploring Justin Fox's The Myth of the Rational Market. This isn't just a dry recounting of economic theories. It's a story filled with compelling characters, dramatic events, and crucial lessons for anyone interested in understanding the world of finance. Our story begins in 1905 with Yale economist Irving Fisher. Imagine a dapper, brilliant professor losing a nearly finished manuscript to a thief at Grand Central Depot. This manuscript was a groundbreaking attempt to apply reason and science to the stock market. Fisher's ideas, though initially ignored by Wall Street, would eventually become cornerstones of modern finance. He championed the idea that investment value could be calculated by discounting future income streams, a concept applicable to both bonds and stocks. This was a revolutionary idea, blurring the lines between the perceived safety of bonds and the speculative nature of stocks. Fisher wasn't entirely alone in his thinking. Around the same time in Paris, Louis Bachelier, a mathematics student, was studying price fluctuations on the Paris bourse. His doctoral thesis used similar mathematical tools to describe market movements as a game of chance. Fisher, however, had an advantage. He was an economist trained in mathematics, living in a country where financial markets were rapidly evolving. He argued that uncertainty in the stock market could be tamed using data and probability theory. Meanwhile, back on Wall Street, data about stocks and bonds was becoming more accessible, leading to the rise of market forecasters. Roger Babson believed in fundamental analysis, using economic data to predict market cycles. William Peter Hamilton, on the other hand, was a proponent of Dow theory, claiming the stock market itself predicted the economy. Fisher's experience with the changing economic landscape led him to believe that market participants often behaved irrationally, like sheep following a single leader. He saw education as the key to making investors less prone to herd behavior and advocated for government policies to stabilize prices. He was also a vocal advocate for market indexes, helping launch the ancestor of what we now know as the S&P 500. Fisher's belief in the power of rational economics to tame market fluctuations eventually led him astray. In the booming 1920s, lulled by his own financial success and the perceived stability of the Federal Reserve, he became convinced that stock prices had reached a permanently high plateau. He was very wrong, and the 1929 crash wiped out his fortune. Fisher's misjudgment highlights a key theme in the book, the seductive power of the rational market myth. While the idea that markets possess a certain wisdom has been around for centuries, the 20th century version was different, both more rigorous and more extreme. This brings us to the 1930s, the era of the Great Depression. Enter Fred Macaulay, an economist who literally flipped a coin to demonstrate the randomness of stock market movements. His coin toss experiment, though initially meant to mock market forecasters, foreshadowed the random walk hypothesis. However, unlike future proponents of this theory, Macaulay acknowledged the limits of pure randomness, arguing that human behavior, especially in the face of uncertainty, was prone to systematic errors that contributed to the business cycle. The 1930s also witnessed the rise of Alfred Cowles III, a newspaper heir who dedicated himself to studying stock market forecasting. His research, conducted with the aid of punch-card calculating machines, showed that professional forecasters couldn't consistently beat the market. At the same time, Holbrook Working, an agricultural economist, was studying futures markets. He initially aimed to debunk the claim that speculators profited at the expense of farmers. His research, however, led him to a more groundbreaking conclusion: the randomness of market movements might actually indicate market efficiency. This was the first clear articulation of what would later become the efficient market hypothesis, although it went largely unnoticed at the time. World War II played a significant role in the development of quantitative finance. The war brought economists and statisticians together to solve complex military problems. This operations research experience, involving calculations of risk and reward in life or death situations, shaped the thinking of future finance scholars like Harry Markowitz. Markowitz, a graduate student at Chicago, revolutionized investing in 1952 with his portfolio theory. He argued that investors should focus not just on the potential return of individual securities, but on the risk of the entire portfolio. His work, directly influenced by wartime operations research, introduced the idea of balancing risk and return. Markowitz's work didn't immediately transform Wall Street. The world wasn't quite ready for quantitative finance. But his ideas, and the groundbreaking work of others, began to reshape academic thinking about markets. Back at MIT, Paul Samuelson rediscovered the work of Louis Bachelier and saw the connection between market randomness and efficient markets. He revised Bachelier's model to account for long-term trends, effectively redefining Brownian motion in economic terms. The random walk hypothesis gained momentum in the late 1950s. Astrophysicist M.F.M. Osborn, drawing on his wartime experience studying molecular chaos, published a paper in 1959 describing stock market movements as Brownian motion. Around the same time, statistician Harry Roberts published a paper challenging the methods of technical analysts who relied on identifying patterns in stock charts. These two papers marked the emergence of the random walk as a serious intellectual movement. Even as economists embraced the efficient market hypothesis, the world of finance remained largely untouched by these theoretical developments. Finance, taught in business schools, was a collection of rules of thumb and practical advice. Franco Modigliani and Merton Miller set out to change that. At Carnegie Tech, they argued that financial decisions should be based on whether they increased shareholder value. Their groundbreaking papers in the late 1950s argued that in a rational market, a company's capital structure and dividend policy were irrelevant to its value. Propositions that challenged long-held beliefs and opened the door for a new, theory-driven approach to finance. Back at Chicago, Eugene Fama, building on the work of his professors and influenced by Miller, articulated the most complete version of the efficient market hypothesis. He argued that prices in an efficient market fully reflect all available information. Fama's work, combined with the availability of new computer databases of stock market data, made Chicago the center of efficient markets research. Fama's argument that beating the market was extremely difficult, if not impossible, began to find its way to Wall Street. One early advocate for indexing was Jack Bogle, who ironically had earlier criticized the idea of unmanaged mutual funds. In the 1970s, as the mutual fund industry became increasingly obsessed with performance, Bogle, now at the helm of Vanguard, launched the first index mutual fund for retail investors. The 1970s also witnessed the rise of new methods for measuring investment performance and risk. Jack Traynor and William Sharpe, building on the capital asset pricing model, developed risk-adjusted performance measures that could filter out the effects of market fluctuations. These measures, while initially used to critique the mutual fund industry, would become standard tools for evaluating investment managers. Roger Ibbotson and Rex Sinquefield, also influenced by Fama and his Chicago colleagues, created an influential series of data yearbooks that provided long-run stock and bond returns and calculated a historical equity risk premium, the extra return investors could expect from owning stocks rather than risk-free government bonds. This work provided a seemingly scientific basis for forecasting future market returns, although it rested on the now shaky assumption that the equity risk premium would remain constant. The efficient market hypothesis, combined with Chicago-style agency theory, also began to reshape corporate behavior. Michael Jensen, a Fama protege, argued that corporations should be run primarily to maximize shareholder value. This idea, coupled with the rise of junk bonds and hostile takeovers, put pressure on executives to prioritize stock prices above all else. The rational market paradigm, however, was not without its challengers. In the 1970s, economists began to question the assumption of perfect rationality. Richard Thaler, inspired by the work of psychologists Daniel Kahneman and Amos Tversky, became a pioneer of behavioral economics, documenting numerous examples of how people made irrational decisions about money. Around the same time, a different kind of challenge emerged: experimental economics. Vernon Smith, building on an experiment by Edward Chamberlain, used laboratory settings to test economic theories. These experiments, while often confirming the power of markets, also showed how bubbles and other irrationalities could develop. Robert Shiller, another challenger of the rational market orthodoxy, showed that stock prices were far more volatile than could be explained by subsequent changes in dividends. This excess volatility, he argued, was evidence of market irrationality. His work, along with that of Larry Summers, threw the efficient market hypothesis into doubt. The debate between rational market proponents and their critics wasn't just theoretical. Warren Buffett, a disciple of value investor Benjamin Graham, consistently beat the market by focusing on the fundamentals of businesses rather than market sentiment. Ed Thorpe, a mathematician and hedge fund manager, used quantitative methods to exploit market inefficiencies, demonstrating that it was possible to beat the market, even if most investors couldn't. The crash of 1987, however, exposed a major flaw in the rational market worldview: the failure to adequately account for risk. Portfolio insurance, a product designed to protect investors from market declines, may have actually exacerbated the crash by triggering a wave of selling. The crash also exposed the limits of the standard models for measuring risk. While some, like Fisher-Black, began to question the assumptions of rational market theory, others, like Gene Fama, doubled down on their beliefs, arguing that the crash was simply the market efficiently processing new information. In the 1990s, Andrei Schleifer, building on the work of behavioral economists and his own research, showed that arbitrage, the mechanism that supposedly kept markets rational, had its limits. His work helped explain why irrationalities could persist in markets and provided a theoretical basis for value investing. The tech bubble of the late 1990s provided further evidence of market irrationality. Investors, fueled by overconfidence and the allure of easy riches, drove internet stock prices to unsustainable levels. Even some proponents of efficient markets, like Michael Jensen, began to question the rationality of the market and the wisdom of tying executive compensation so closely to stock prices. As the tech bubble deflated, the debate over market rationality entered a new phase. While behavioral economics gained prominence, efficient market proponents, like Fama, continued to defend their theories, albeit with modified assumptions. The debate remained unresolved. By the early 2000s, behavioral finance had become a legitimate field of study, with researchers like Terence O'Dean documenting the irrational behavior of individual investors. This research had practical implications, leading to the development of nudges and other mechanisms to encourage better financial decision-making, especially in the context of 401ks and other retirement savings plans. Even Fama, working with Kenneth French, began to acknowledge that markets could misprice securities for extended periods. The debate had shifted from whether markets were efficient to how inefficient they were, and how long those inefficiencies could persist. The financial crisis of 2007 to 2009, however, provided a stark reminder of the limits of rational market theory. The housing bubble, fueled by easy credit and complex financial instruments, exposed the flaws in quantitative risk models and the dangers of relying too heavily on market efficiency. The crisis also highlighted the interconnectedness of markets and the potential for seemingly isolated events, like the collapse of Lehman Brothers, to trigger systemic panic. This brings us to the book's main takeaway. While markets are often efficient, they are not always rational. Human behavior, with its biases and irrationalities, plays a significant role in shaping market outcomes. Understanding these behavioral factors is crucial for both investors and policymakers. Here are some easy-to-remember heuristics from the book. Don't try to outsmart the market. Start with the assumption that the market is smarter than you. If you have a truly unique insight, test it rigorously. Be wary of new things. New financial products and technologies are often accompanied by underestimated risks. Don't ignore the fundamentals. While market sentiment matters, the long-run value of a business depends on its ability to generate cash flow. Be mindful of your own biases. Overconfidence and other behavioral quirks can lead to poor investment decisions. Cost matters. When choosing a money manager, lower fees are a good predictor of better performance. Diversify. Build a portfolio of uncorrelated assets to balance risk and return. Don't chase hot funds. Past performance is not a reliable indicator of future success. Save more tomorrow. Automate your savings to avoid the temptation to spend today. Markets are not always wise. While they contain information, they also reflect emotion and error. The myth of the rational market offers a crucial lesson. While financial markets are powerful engines of economic growth, they are also prone to irrationality and excess. Understanding the limits of market rationality is essential for navigating the complex world of finance and building a more stable and prosperous economy. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.